Hello everyone, welcome back to this four-part series on creating and developing a trading plan. My name is Cameron May, I'm a senior manager here at Schwab. And in our first video in this series, we talked about how a trader might make a plan for what kinds of stocks to buy and how many shares to buy. And today we're talking about how that trader might make a plan for when to buy those shares. So let's dive right into it. All right, so today's session 2 in our series is called Entry Strategy. And before we dive into that, I do want to issue another invitation to you. If you're not following me on X, please do that. It's a great resource to connect with your favorite presenters when they're not in a webcast or delivering a video. You can follow me on X at Cameron May CS. But with that said, let's get right into it. First thing we always pause to do is to consider the risks of trading. Risks are significant, so bear this important information in mind. The information provided here is for general informational purposes only and should not be considered an individualized recommendation or endorsement or personalized investment advice. Paper money success is not a guarantee that you're going to have success with your real funds. Schwab does not recommend using technical analysis as one sole source of investment research. Investing involves risks, including the loss of capital. And with that said, let's get a quick reminder of where we've been in this series and where we're headed. In session 1, we discussed how a trader might make a plan, deciding upon their trade style, their time horizon, and their position size. In session 2, we're discussing our entry strategy. How might a trader make a plan for precisely when they plan to enter those shares? In our session 3 discussion, we're going to get into making the back-end plan for trade management, which is the exit plan. And finally, how do we assess our trade plan performance and hopefully make revisions and improvements on it in the future? Okay, so getting to today's agenda, 3 items on the agenda. First thing that we want to do is go through some typical entry strategy considerations. When a trader looks at a chart and they're attempting to refine their timing of an entry, what sorts of things might they be looking for? What sorts of things might they be adding to that plan? Then we're going to get into an example of that sort of a thing. Example entry strategies, including 2 today. We're going to go through what's known as a bullish breakout and also a bullish bounce. We're going to be focusing on the bullish side of trading in this series because it seems to be the most intuitive for those that are first learning and first developing their very first trading plan. Then we're going to wrap things up with a strategy demonstration on the thinkorswim desktop software platform that we got introduced to in video 1. And we're going to use those watch list stocks that we found from that session 1 discussion. So let's get right to our discussion of entry strategies. So when building your trade plan, traders very typically include a specific plan for when they're either going to enter new shares and when they're going to exit those. Now, for some, there's more of an emphasis on what we've discussed is called fundamental analysis, and others are more technical. So, having defined their trade plan parameters of trade style, time frame, and position size, and having built a watch list of matching stocks, traders will typically take 2 approaches to the timing of entries and exits. The first is to buy and sell without really any consideration of price chart behaviors. Instead, entering and exiting stocks according to things such as diversification needs and personal convictions regarding market conditions. Things like changing company fundamental strengths, that sort of a thing. These are our traders, as I mentioned, that are primarily what we call fundamental investors. And for the style of trader that we've discussed to this point, these might be more in the category of what we call a position trader. Now, others will incorporate chart analysis into the planned timing of their entries and exits. This will include a careful review of technical price chart developments in an effort to assist with the timing of stock entries and stock exits, and these are what we call our technical traders. Now, of course, they may still consider fundamentals, as we did in session 1, before referring to those charts for those trade signals. So that would be, if we're using fundamentals and technicals, our hybrid style of trader, okay? But let's talk about some potential considerations as we're building a trading plan building out that element of our trading plan for our entry signals or our entry strategy. So here's some potential technical considerations when building an entry strategy. Very first thing, when a trader brings up a brand new fresh stock that they've never seen before, maybe one that they haven't seen in quite some time, is they might look to determine the trend of that stock. For a number of traders, it's important to them to trade in the direction of an established trend, with the assumption that a trend, once underway, may tend to persist. Now, it's not a guarantee that that trend is going to continue, but there are a broad number of traders who make that assumption and they build their trade around that. So if they have a stock that's moving bullishly, the trades that they enter on that stock are going to be primarily bullish. If the trade is moving bearishly, either they hold off on new bullish entries or they take new bearish positions. So these technical traders often prefer to take positions consistent with the direction of the prevailing stock trend, defined, and the trend is defined by such techniques as a manual analysis of the trend. They may just apply their own experience and their own discretion to the analysis of that stock trend. Others, though, may prefer to lean on technical indicators or studies to assist with that trend identification. And they'll use automated chart tools such as moving averages. That's a very common, probably the most common would be a simple moving average. That's a technical tool that can be applied to a trader's chart to, among other potential benefits of a simple moving average. One of those is to assist with trend identification. Once the trend has been established for the trader, they may then move on to an exercise of looking for what we call price floors and price ceilings, otherwise known as support and resistance. Sometimes you'll hear us use those terms in technical lingo. Support is just referring to a price floor. It's like prices are being supported from below, or we'll refer to those as resistance. A ceiling is resistance, as though price advances are being resisted from some force from above. It's really just sell orders, basically. But the purpose here is that a trader, once they've identified a trend, let's say a bullish trend, they'll still recognize that trend will tend to ebb and flow. It'll go through short-term peaks and troughs, little waves or stair steps. And the effort here is to attempt to get in toward the bottom of a cyclical low rather than at the peak of a cyclical high. Even within a trend, there can at least be conceptually better or worse times to get into that trend. So once the trend has been identified, some traders will attempt to refine their entries by looking for price support or resistance. Then finally, there are some traders who will take it a step further into granularity for the timing by looking at individual candle by candle behavior. So this is where we're looking at, let's say we're on a daily chart. They may look at what's happening from a day-to-day basis to confirm that that day's price behavior is in keeping with where they think the stock is relative to price floors and price ceilings, and in keeping with the current direction of the trend. So those traders are seeking to further refine that entry timing. They'll sometimes wait for specific candle by candle behavior as price approaches those support or resistance levels. And we're going to be going through examples of this in good detail. But what I wanted to talk about here, try to pull all of these three considerations together into some example entry signals. Okay? So our first example entry strategy is what's known as a resistance breakout. So you'll notice here on our chart, we have a red line that may identify for some a price ceiling. And ceilings, as I mentioned, are known as resistance. It's almost as though there is a force from above holding prices down. And you can see on our example chart, assuming these are daily candles, this stretched out for a period of months where price really could not rally up above that resistance level. Even with our trend established, you'll notice here, we rallied up to that resistance area and then pulled back to a cyclical low. And if we look at those cyclical lows, there's a low and there's a low. That's what some would define as a higher low. Here's a high. We're struggling against the previous highs, so we have equal highs. For some trend traders, they would not consider this to be an upward trend until we broke up above that high. Higher high and higher low is commonly identified as a trend. But for our trader looking for a resistance breakout, they'll first of all confirm that the trend is up or at least sideways, and it does seem that we have at least the argument for sideways here, and then wait for price to rise up to resistance and then push through on what we call a breakout. That could be just a green candle pushing up and through and closing, and I'll talk about that in greater detail in just a moment, above that price ceiling. And finally, for traders looking at this as an entry signal, they may look for volume to confirm. So here's our volume bars down at the bottom. What we'd like to see is a spike in volume above average on that chart. Okay? So why do some traders consider a breakout to be technically significant? Well, it's a new development on a stock, and just to put yourself in the shoes of a trader who has watched this in the past. Let's say we've held shares, watched them run up to this resistance level, this ceiling, get pushed back, run up to that resistance level and get pushed back, run up to that resistance level and get pushed back. You can see that traders may be hesitant to take new positions until they see that change. I mean, who wants to be the trader that's buying just below where we think the price is about to reverse back down again? So the trader is waiting for a break above that ceiling, relieving the pressure of maybe this being the next sell-off, or at least conceptually, and there's our breakout. So let's go see this on a chart. And I wanted to discuss this one using our CMG position from session 1. So here's just to quickly recap. We bought 170 shares. That was a $10,000 position at a trade price of $58.17. You can see right now the trade price $58.54. We're up about $63 on that position. But as we go to our chart, this is interesting, not planned, this is just the way that it worked out, was that our stock appears to be making higher highs and higher lows. So let's establish trend first. You can see that cyclically, we ran up on CMG to right about here, about 56.5, and then pulled down to a low down here around 48-ish, rallied up to about 57 and change, so higher than the previous high, and then cycled back down to a new low that exceeded the previous low. So our trend trader who's establishing the trend visually, applying their own expertise and their own experience to this chart, may come to the conclusion, if this is their approach, that this trend is upward. Now, what I noted in reviewing our CMG trade is that we're also breaking through recent price ceilings right through about that 57-ish range. You'll notice our first high was just below 57, our second high was just above 57, but in both cases, we were pushed back from that price ceiling or that resistance level just as we approached it. But then just as we placed our trade in our video, we didn't look to confirm this, that was what we intended to discuss in this video, price was actually rising up and through that resistance. So to some, they may see this as a resistance breakout. Now, there was a third element here, though, that may cause some traders to hesitate, may cause some traders to object. What do you see on your screen? And it might help if I zoom in here. On thinkorswim's chart feature, we can click and drag and highlight a specific period of time. What might some technical traders object to in their trade plan for breakouts, according to how we defined it in our three-step process there? We had trend, we had support and resistance, and then also on that entry, quite commonly, we're looking for an increase in volume. And as you look at this tiny little volume histogram bar, not much of an increase there. So for some, they may say, well, it looks like we're breaking out, but if the conviction of the breakout is measured in terms of volume, maybe this one isn't the day. Now, I do want to acknowledge that some in our audience today aren't even going to quite know the basic construction of a candle. So I do want to recap that quickly, because with a breakout, quite commonly, the trader is waiting for the close of trading to confirm the breakout. We want to see a close above that resistance level. So it does require that we know the open high, the low, and the close of each candle. So let's talk about these white candles and these red candles. So a white candle simply is a candle, well, it tells us four things. The high point and the low point of that candle tell us the highest price and the lowest price for the day. And then the body of the candle tells us the open and the close. And we can tell which is the open and which is the close. With a white candle, the open is at the bottom and the close is at the top of this body or the square part of the candle. So we can look here and say, okay, so the close on this candle was up here at the top. With a red, it has the same four basic elements. The high and the low are just the high and the low of the trading session on the daily candle. But a red body tells us that the open was at the top of the body and the close was down at the bottom. So we do need to know that in order to make this confirmation if we're using those candles. All right, so that is our first example entry signal. Let's go back and have a look at example entry signal number 2, which is something known as a bounce. For some traders, they'll first look to confirm that the trend is up or sideways, either applying their own discretion or they may recruit a technical indicator. But once that trend has been confirmed as either up or at least sideways, then they'll look for price to pull back down to a cyclical low and try to enter as the price starts to rise again, confirming hopefully that momentum has shifted back up. We're not trying to catch a falling knife, and the price is starting to rise back up in the direction of the established trend. So as price falls to support, then begins to rise again or bounces up from that support, that may be the signal for entry. And for some, that's perfectly serviceable. They'll look for the trend up or sideways, and then they'll look for a drop back down to support, and even the appearance of a white or a green candle, green in most circumstances, just like white, that might be adequate for their entry signal. However, some take it a step further, and to specifically confirm that bounce entry, they'll look for a pattern known as a hold entry confirmation. So they're looking for prices to close above the high of the low day. CAHOLD is the acronym. Doesn't always exactly roll off the tongue, but it's a confirmation for some that we're getting that bounce. So let's use this as an example. What does that acronym mean? Well, it means that price has been falling down, and as we're pulling back down to support and approaching support, the trader looks for the lowest candle on that pullback. And for some, they'll define that by just which one sticks its little tail down the furthest or which is the smallest candle closest to support. And then they'll look for a closing price above the high of that low day. So they'll look at that low candle, establish its highest price, and look for a close above that. So here's what that looks like on a real example. How about we pull another stock from our watch list from session 1. I took a look before we launched this video, and I found that MTCH apparently had an upward trend. Now in this case, we're going to use a little bit of a different trend confirmation. Instead of applying a trader's discretion, looking for higher highs and higher lows, for example, we're going to use a technical indicator known as a simple moving average. In my experience, this is probably, and again, this is anecdotal, don't have the specific data to back this up, but in my experience of doing this for decades, this is probably the technical indicator that I see most commonly applied to trader charts. So to add that to our chart on thinkorswim, I'm going to click on the Flask Edit Studies icon up here at the top. Let's type in our menu here, simple for simple moving average. I'm going to choose that, add that to our chart. And before I apply it, I am going to change the default parameters of this study. By default, you'll see this is using 9 days or 9 periods of data. I'm going to expand that out. Let's click on the little gear icon off here to the right and change the length of our study, our simple moving average, to 50. And I'll explain what that means in just a moment. But let's click OK, click Apply, and click OK again. And what we're left with here is a green line that's just oscillating back and forth through our chart. And for some traders, among other potential purposes, including, interestingly, this line might be used as support and resistance or price floors and price ceilings. One of the potential implications of a simple moving average is trend. If it's pointing upward, what that's telling us is that the average price over time is generally rising. So the specific construction of this indicator Since we chose 50 as our data set, this is looking back over the last 50 trading sessions, that's about 2.5 months, and it's applying a dot, conceptually, at the average closing price for those 50 sessions. So right now, that's right around $35.16, right here. Well, over time, that average value changes. So for example, if we were to go back here in July, prices had been generally lower, so the average price is going to be lower at close. Average closing price is going to be lower. So for some traders, they see those gradual changes in average closing values as an indication of where the trend is actually headed, instead of just looking at day-to-day candle behaviors, okay? So in this case, we have our trend apparently moving higher. So there's step number one. Next up, the trader might be looking for support. So they might be looking for one of these cyclical floors. Now, one way that might be established is to draw a diagonal line. Sometimes support is seen as moving along at a diagonally ascending angular level, very much like a ramp. But in this case, we have a rising price floor. The price rises up from it, pulls back and bounces off of it. Rises up from it, pulls back and bounces off of it. So that's one way that a price floor might be established. Another way, sometimes traders will just look for horizontal levels of support. For example, here's a previous example right back here, where price is rising and falling, hitting cyclical lows, rising up and falling down to similar cyclical lows. But a third way that traders might look for support is to just use the average price itself. Imagine prices have been well above average, and as they're pulling back to average, maybe there are traders waiting out there to get in, be able to console themselves and say, hey, at least I'm getting in at or near average levels. Yeah, that can cause prices to bottom out and start to rise again. Certainly not a guarantee. So we have trend, we have support and resistance in this example entry strategy. But then finally, we might be looking for a close above the high of the low day, a hold entry. Let me zoom in on this and let's talk through this. We have a couple of examples here. So as I mentioned, the trader is looking for their upward trending stock. They've identified potential support, in this case taking the form of either this trend line or this the moving average. And they might wait for price to pull back down in the vicinity of that support. And then to identify the hold entry, first of all, we look for the lowest candle. In this pullback, the lowest candle was this one, this white candle. And at that point, we wait for a subsequent day where we close above the high. Here's the high of that candle. We wait for a close above the high of that low day. Next day did not close above that high, so we're still waiting. The day following that, here's our close, our white candle, top of the body, closed above the high of the low day. That's the entry signal for our trader, and the confirmation may be that we are upward trending, bouncing off support, and prices are starting to move higher again. Hopefully, that might refine the entry. Here's another example, pulling back. Where's our low day? It looks like this candle right here. Didn't close above it on this day or this day. Finally, we got to close above on this third day following. So there's our hold entry. And those are two examples of how a trader may make an entry strategy. And I hope what you're doing as we're detailing these sorts of examples, I hope that you're exploring these and thinking, how might I change this to suit my approach? It may be a different time frame. It may be maybe a trader has a preference of using volume as confirmation or not. Maybe they're not waiting on candles. Maybe they have a different technical indicator that prefer lots of different ways that these might be tailored to suit one's preferred approach to trading. But here's what we're going to do now. We need to add to our now building example portfolio. We already own shares of CMG. Let's be consistent with our session one entry. We bought $10,000 worth of CMG. Let's buy another $10,000 worth of Match Group. So to place that trade, we're going to go up here, click on our trade tab. We have our, in this case, bounce entry strategy confirmation. Let's click on trade. let's make sure that we've entered MTCH. And a quick way to place a trade on thinkorswim is just to click on the ask price. So I'm going to click on the ask price. This will allow us to tailor, among other things, the number of shares we intend to purchase. Now, we don't know how many shares we want to purchase at this point, but it looks like our last trading price was right at, if you'll forgive me, I'm going to round just a little bit, right at $36. Okay? Looks like in the pre-market activity while I'm recording this video, there's a bit of a spread between the bid and the ask. This is known as skew. It's quite normal. But I'm going to go to our calculator and let's assume when markets resume trading in a few minutes here that we're able to buy our shares for around $36. Well, $10,000 of investment maximum divided by $36 per share, pardon me, is around 277 shares, okay? So let's just erase what's in here by default, enter 277. If you need to see any field here on your order screen a little bit better, you can just click on the margin in between the fields and just drag that back and forth. There we go. 277 shares of MTCH stock. By default, this is going to enter a limit order. A limit order simply means we're putting a ceiling on how much we're willing to spend on a per share basis. Now, that can have obvious advantages in that one doesn't overspend or spend more than they intended to pay on a per share basis, but it also carries the risk that the order might not fill. If the shares are not available at that price or lower, that buy limit order is not going to fill. So I'm going to actually switch this to a market order saying, hey, whatever it costs me to get into these shares, once that opening bell rings, I want to be in that trade. That's what this is going to do. Obviously, that carries risks as well. We might unintentionally exceed our $10,000 limit, for example. So I'm going to click confirm and send. We're going to buy 277 shares of MTCH at the market price. That should be around $10,000. There's no commission to be paid on this trade, but there can be on certain types of trades. And we need to remember that with market orders, prices can change quickly in fast market conditions, resulting in execution prices that can be different from the quotes displayed at order entry. But I'm going to send that order off, and now we own some CMG, we own MTCH, but of course, we have no idea when we intend to sell. When are we going to take profits? When are we going to take losses? That's the next element in a trader making a more robust trade plan. So yeah, coming up in video number 3, in session 3, we're going to be talking about that exit plan. All right. But we've accomplished what we set out to do today. Let's do a quick recap. We've gone through our entry strategy considerations, introduced 2 example entry strategies, bullish breakouts and bounces, and we've demonstrated those strategies on thinkorswim desktop trading software, that platform, using the session 1 watch list. So we'll see how those 2 trades perform as we continue through our video series. But it is time to move on to session 3, which is our exit plan. Next session, session 3, exit plan. Time for me to let you go. Get ready for our next session. Of course, I want to give you a quick reminder of additional resources that are available to you outside of these sessions. First suggestion that I might make is that you follow me on X. You can find me on X at Cameron May CS. Also follow your other favorite presenters here at Schwab. This is the best place to connect with your favorite presenters in between videos, or we also do live stream videos on our Trader Talks channel. But following us on X doesn't cost anything, literally only takes a moment. Also do, though, follow us or subscribe to our Trader Talks Schwab Coaching webcast channel on YouTube. This is the very best place to find our playlists of previously delivered webcasts. There are hundreds of webcasts here on a range of topics, but they're organized by topic and by series. Or you can also join a live webcast. We have 7 or 8 new webcasts every single new market day. As long as the markets are open, we're on here doing our webcasts. So we'd love to have you here. All right. But everyone, it's time for me to turn you loose. Thank you for giving me your time today. I'll look forward to seeing you in session 3, our exit plan discussion. But whenever I see you again, I do want to wish you the very best of luck. Happy trading. Bye-bye.